Nick, talk about ETFs and why ETFs are just amazing from an active management strategy and tax. You and I have been talking about this.
Yeah, and I think it was in both of our minds for a while too, in terms of we both arrived at the same conclusion of you can do whatever you can do, but at the end of the day, it comes back to a tax strategy. Not everyone's going to have the funds in a retirement account and run a separately managed account where they can do a model portfolio. And just from a trajectory of where things were going in terms of mutual funds to, oh, we can break out the mutual funds to a separately managed account for you. We can do indexes. We can do custom indexes. We can do this. But then generally, though, when we move away from indexes, when it's more research-based, when there's more active management, there's not an easy way of keeping up with the trends in a tax-efficient manner. And that's why all roads lead back to the ETF.
So why is an ETF better than a mutual fund?
One main difference with an exchange traded fund is how they do new shares in terms of creating new shares or redeeming shares. And they can do that in basically to minimize taxes. They can use what's called an in-kind creation and will allow them to transfer stock or trade stock as is, so that they're not creating a taxable event as they're updating the index. And since now anyone can create an index, what is an index? It's beyond just S&P 500 or the NASDAQ. And as things are going, if you have a process of saying, okay, we can take these baskets of very high, low cost bases, a lot of taxable gains embedded, and we're able to swap them out. But we also have flows going in and out of these ETFs at the same time. So you do have these older investors and newer investors. So creating an ETF in itself gives a great opportunity, just looking for an ETF that's currently on the market as well.
I agree. And I'll play that back. Look, if you have, say, NVIDIA or Bitcoin that's highly appreciated and you don't want to sell it, you don't want to pay tax. That's partially why you don't want to sell it. And maybe you believe in the thesis, but you're saying, I'm way overweight on this asset. Then you can vend your securities into an ETF and then get delivered an ETF and not pay tax. That's what this in-kind transaction is. That is a massive tax opportunity. I can't say that enough. Just a massive tax opportunity, right?
On top of that, too, it's also allowing to run systematic strategies on positions that you already own. I mean, we were talking about NVIDIA. It's a great example because everyone knows it. Everyone understands that they have this potential. But what if it goes sideways? Well, that in itself is a trading strategy in itself. If something is showing itself to be in a trading range, there's a lot of advantages of writing kind of cover calls or cash secure puts or ways of entry or exiting a position. So having that run an ETF, yes, there's going to be some taxes. We're not saying that they're purely like, oh, this is great, but the advantages far outweigh just trying to do it yourself, especially if you believe in the concepts of what is being added or being removed in terms of the investment philosophy behind the actual ETF. And that, I think, is what I'm most excited about too. There's nothing really on the available now that has all those. There's things out there that all kind of touch on these different themes, but there's nothing that's really saying this is one encapsulated way of just getting the entire breadth and depth of everything.
Well, I think, look, having markets today with this hot ball liquidity that's bidding up asset prices quickly, and then it moves on. We see that in a lot of places, right? Dell ran up 100% in the first 4 months of this year. And we looked at that and we bought it. We own that. And we said, okay, this thing is more expensive than it's ever been in its life, looking on a trailing PE basis or even forward PE basis. We said, we want to sell this, but we don't want to pay taxes. We want to sell it from a risk management perspective. We want to rotate it. That's what you would do if you didn't have to consider taxes. So we sold it. The stock reported earnings and it dropped 20%. So it was a good decision, but now we have to pay taxes on that. So NVIDIA is a good example. So we had, I'm going to call it the Kathy Wood top last Wednesday. If Kathy and I ever meet and do a selfie, it'll be like a positron and electron coming together. Like the simulation will end. It's going to be amazing if that ever happens. But in any case, we had the Kathy Wood top last week. You can see it on the screen here, right? I think she was buying some semiconductors like AMD and TSM and an ARKW fund, I believe. And you can see this coming a mile away. Of course you want to de-risk. And if you look at how overextended NVIDIA is, of course you want to sell. But if we do, we pay taxes, and a lot of taxes. So we have a low basis. Now, here's the point. If the strategy is wrapped in an ETF, the ETF can be dynamic and it can buy and sell. And those taxable gains are not being passed through to to the owner of the ETF. The owner of the ETF, they log into their Fidelity, Schwab, Robinhood account. They just own that ETF. They're not going to pay tax until they sell the ETF. So the point is, what would have been taxed gets transformed and accrues value. This is massive. So it benefits active strategies the most. That's the key takeaway.
Yeah, and it's called a Part B trade if folks want to look into more of it. But again, for everything that active managers are trying to do, this is probably, why not take advantage of the vehicle that's being handed to you, right? Just makes perfect sense.
Of course, folks that own, let's say, VOO, Vanguard's S&P 500, they know this. So you're not paying taxes every time the S&P 500 rebalances. Or if they drop a name and then they add a name like Apollo to the category, to the S&P, you're not paying taxes on it, which is massive.
Or transaction fees, because you're not actually buying or selling.
Look, eventually there will be a correction. There will be a risk-off market. I don't think we're there yet. Talked about some of the kind of risks. But if you can de-risk or rotate within an ETF and not have to sell the ETF, that is absolutely massive, right? Imagine there will be a time when we look at, say, BAML's flow show report, or we look at sentiment indicators like the AAII net bull bear ratio. It'll be like 2 standard deviations above. You're going to see the ARK ETF at high, right? You're going to see unprofitable tech ripping. You're going to see retail open to buy options at high. Those are all the telltale signs of a market top. Maybe IPOs are back and bad IPOs are back. That's a sign of a top, right? SPACs. We saw all that in 2021, by the way. We saw all of that in late 2021, right? Sometime like that will happen. And we're going to look around and say, okay, what do I do? Do I sell and pay a boatload of taxes? Or do I just suffer a drawdown? And the answer is, if the strategy is wrapped by an ETF, then you have an answer. The answer would be to rotate. That's the answer. Rotations give risk management support, right? Because you're rotating to something that has more upside and less downside. For example, we rotated to energy 2 weeks ago. I'm not worried about energy stocks. In fact, the seasonality for energy is very good now. And then, of course, you have the commodity rally that we talked about earlier. So yeah, we're excited. I think Nick and I are going to do a show dedicated to really exotic ETFs too. There's so many interesting ETFs. Do you want to describe one or two of those as a teaser, Nick?
I would say there's going to be active management, and then there's going to be the passive investor that's going to say, I just want to have market level returns. Good for them. But even in that situation, there are now options that are being embedded in these types of investments that allow you to trade off upside versus downside capture. So they're basically buying protected puts, selling cover calls, or basically collaring a position around a certain level. What they're basically doing, a company like Innovator Shares, is creating risk-defined ETFs similar to annuities without the annuity wrapper. So you can get the same level of returns without necessarily paying higher expenses going through the annuity route. So that's one example. Others are basically paying like out of the money put spreads for a way of providing some sort of like a positive return in a very negative market, in terms of more of a snapback market, where if something is more of a market crash, like a 5% is not really going to cut it. But if it's a 10, 15, 20% market correction, then those types of investments will go up in value. They're using these in replacement, again, from what Ron was saying. Instead of trying to sell the positions or collar the positions or do that, okay, if we can add it as a portfolio level, then this can maybe offset that, and is putting in bandages on a portfolio, in my opinion. There's a benefit to it, but it's not solving the systematic issue, which lies at the center of many people, which is when they sell, they know that they have a guaranteed loss. So how do they mitigate that loss? Most people can ride through a 5% correction, even 10% correction, if they know it's going to eventually come back. But if they're going to sell 20+% in their taxes, then they're like, that's never going to come back. So we need to solve the core issue first.
Absolutely. So we're going to build a website called lumidaetf.com. Stay tuned for it. I'm really excited about this. It plays so well to our approach because we can be nimble.